Welcome to this Handtech Markets video on position sizing. While choosing the right levels for entering a trade, and in particular for exiting a trade, are very important, it's equally important to make sure your trades are the right size. If you trade a position that is too large, you may be exposing your account to excessive levels of risk. On the other hand, if you trade positions that are too small, you may be seriously underutilizing your capital, causing you to miss out on making the most of otherwise profitable opportunities. Given the high levels of leverage available on your FX trading account, the one thing you probably don't want to do is to trade the largest position possible each time you place a trade. Doing this will leave very little room for any price fluctuations against your trade. A quick search of the internet will show you that there are many different ways to determine position size. There are simple fixed lot strategies, fixed fractional percentage strategies, and more complex tools that involve determining the risk of ruin, and even some with imaginative names such as optimal F. Even the most simple of these methods will yield better results than sticking your head in the sand and ignoring the whole topic, which, unfortunately, is the approach taken by many retail traders. Determining exactly which method is best for you will depend greatly on your risk tolerance and your willingness to perform the necessary calculations. A fixed lot system is arguably the simplest. Using this method, the trader simply trades the same position size on each trade, for example, one standard lot. The problem with this method is that it does not allow for changes in the size of the trading account balance, nor does it allow for different lot sizes. For example, one lot in a pair with sterling as the base currency is considerably larger than one lot in a pair with Kiwi as the base currency. One system that is quite popular and yet relatively simple is the fixed fractional position sizing methodology. Using this method, the trader predetermines what percentage of their overall account balance they are willing to risk on each trade, and then works backwards from that point to work out how large a position they're able to take, given the proposed entry level and planned stop-loss level. Not surprisingly, different traders have different levels of risk tolerance. Some traders that employ this methodology allow themselves to risk no more than 1% of their account balance on any one trade. Others feel that they will never make any progress unless they allow themselves between 5% and 10% risk per trade. A popular figure among many retail traders is 2%. While you must determine for yourself what level of risk you are comfortable with, we will use 2% for the purpose of illustrating the methodology in this video. Having predetermined the amount of risk you're willing to take per trade, apply this to your account balance to reflect the actual amount of money you are willing to risk per trade. For example, if you're willing to risk 2% of your account balance on any single trade and your account is held in US dollars with a balance of $10,000, the amount you're willing to risk per trade is 0.02 times 10,000 US dollars, which equals 200 US dollars. The next step is to choose an entry price and a stop-loss price at which you will exit the trade if it goes against you. If you plan on entering the trade at the market price, use the current ask price if going long, or the current bid price if going short. If you plan to enter the trade with a limit order or by buying or selling on stop, use that price as the entry level for your calculations. When choosing the stop-loss, use whatever methodology you would normally use, whether it be based on levels of support or resistance visible on the chart, a moving average, or even some other tool such as a parabolic stop and reverse, or even a trend line. Once you've chosen an entry level and stop-loss level, calculate the number of pips between them. For example, if trading Aussie US with an entry of say 1.0364 and a stop-loss at let's say 1.0352, the difference between these levels is 12 pips. Next, work out the value of these pips for a trade of one standard lot. If you're trading a standard account, one lot usually has a face value equal to 100,000 units of the base currency, the one on the left of the pair. If you're trading a mini account, one lot may have a face value of just 10,000 units of the base currency. By multiplying the face value of one standard lot by the number of pips between the entry price and the stop-loss price, expressed as a decimal, you will arrive at a figure that shows the value of this price movement expressed in the terms or quoted currency. In this example, we're trading Aussie US on an account that is denominated in US dollars. If the terms currency is the same as the currency in which your account is denominated, which it is in this example, the last step is relatively easy. Take the result of the very first calculation, the amount you're willing to risk per trade, and divide this by the value of the move. This will give you the number of lots to trade. If the terms currency is not the same as the currency in which your account is denominated, you need to perform an additional calculation in order to convert this figure. Keeping with our previous example, if you're planning to take this Aussie US trade but your account is denominated in euros instead of US dollars, you'll need to use the euro-dollar rate to convert the value of the risk into euros before executing the final calculation to determine the number of lots to be traded. Of course, if your account is held in sterling and you're trading Aussie US, you'll need to use the sterling US rate for your conversion. Once you become comfortable with these calculations, you might like to investigate ways of enhancing the methodology. For instance, instead of using the simple account balance as your starting point, you might also want to include the value of current open positions. Or as a further tweak, you might want to include the value of current open positions at their stop-loss value. You'll soon notice that there is an inverse correlation between the size of the stop-loss and the size of the position that should be traded. If you use a wide stop, this method will result in relatively small positions. However, if you have a little more confidence in your trades and use tighter stops, the system will allow correspondingly larger positions. Be sure to view our other videos to learn more about understanding risk, capital preservation, and reward to risk ratios.